Okay, welcome back, friends. Welcome back. Delighted to have you in this advanced course series of Equity Nigeria. Um, I believe you probably have gone through the beginners course series and also the intermediate course series. I believe you got value, you learned something, you're becoming better as regards your trading ambitions and your trading desires. All right. Um, the advanced course is also to introduce you to certain important things as regards trading to build you up in the areas of risk management, in the areas of strategy management, and more, so that you can become the professional and the profitable forex trader that you've always desired. All right, so let's quickly get to business. So in this advanced course series, one very broad topic we will talk about that covers a large area of majority of the things we will talk about is trading plan. All right. So let me ask you the question: have you ever been told about a trading plan, or have you ever heard of the word trading plan? All right. So no worries. If you've never heard of trading plan, very shortly I'm going to tell you what a trading plan is. All right. So basically, what we're going to be looking at in this advanced course is how to set up a successful trading plan. But as the word plan goes, of course, you have to plan yourself. All right. In everything you do, Winston Churchill says, "He who fails to plan is planning to fail." All right. This cannot be this cannot be overflogged. Planning, all right. He who fails to plan is planning to fail. Is also very much applicable to trading the global financial market. Now, one very common attribute to the vast majority of successful traders is that they create and follow a good trading plan. Yes, every successful trader that you see that had been successfully trading the market over a period of time, one thing that is very common among them is that they create and then they stick to the trading plan that they have created. Right? So, a good trading plan comprises of the following, which we will talk about individually. All right. So, what does a good trading plan comprise? Number one, to form your market ideology. All right, I'm going to explain all of this. Number two, to choose the market that fits your trading strategy. Number three, choose a trading time frame. Number four, choose a technical tool to determine the trend, that is a market direction. And number five, define your entry point trigger, and then plan your exit point trigger as well. Then define your risk. Number seven is write down your trading rules. Right, that should be number eight. Yeah, write down your trading rules. Number nine, backtest your trading strategy. Backtest your trading strategy. And then the last but not the least, which is the tenth one, is plan how to improve your trading strategy. Don't be antiquated. Don't stick to one. Don't stick to just what you know. Learn to want to expand. All right. So let's quickly look at all of these in details. Basically, a trading strategy should cover these three main things. All right, a trading strategy should cover these three main words, these three main themes. One is psychology, two is risk management, and three is entry and exit systems. Number one is psychology, number two, risk management, and number three, entry and exit systems, which depends on the technical strategy that you are using. All right. So in most cases, when we talk about psychology, in most cases, how a trader feels before and after taking a trade are quite different. Now, considering psychology is to have a set of rules which keeps the trader in check. Of course, you need to have certain rules, certain laid down rules to keep you in check whenever you want to trade. Why? Because most certainly and often times than none, the way a trader feels before he takes a trade is so much different from the way he feels after taking the trade. Of course, if your trade is going on loss, you will be pressured. And if your trade is if your trade is going on profit, you'll be super excited. But at that time, anxiety can set in. At that time, a little fear can also set in. Should I close with this little profit that I have seen, or should I still wait to gob more profits? All right. Now, if you don't have rules, of course, trust me, you will be cashing out most of the time. You will be closing your trades on small losses, whereas your trade setup have the potential to give you bigger profit. Sorry, if you don't have set down rules, you will be closing your trade most of the time on small profits, whereas your trade setups have the potential to give you huge profits. All right. Now, only rules will keep you in check. Only rules will tell you, okay, it's not yet time to close my trade. Only lay down rules can not make you not feel pressured or feel fear when a trade is going against you. All right, there should be a rule for you to know how to validate your trend. Okay, is this trend still valid? Okay, if it's still valid, then I can leave my trade. While I'm in negative is because of a little retracement in the market, and actually it's going to correct itself and pull up in the overall market sentiment. All right, so psychology is very, 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 very important. The next we'll talk about is the risk management. Now, without a proper risk management rules and setup, trading plan will definitely fail. All right, so no matter how beautiful your strategy could be, no matter how gorgeous it could be, probably it's giving you 70% win ratio, your strategy is giving you 80% win ratio. If you don't know how to manage your risk, trust me, your trading plan is going to fail. You're still going to go broke. All right. So in course of these advanced courses, I'm going to be teaching you a lot about risk management. I'm going to be teaching you so much about risk management just shortly. The next we will talk about is the entry and the exit systems. Now, the quality of a trade is also measured by how good your entry and exit system could be. A technical system for entry and exit will increase your winning ratio. Yes, as much as you find good entry to the market, you should also know when it is good for you to exit what the market. Now, once you can have your psychology put in place with some set of rules, and then you also have a rules and setup in your trading plan that guides your risk management, and then you also have a good technical strategy which you can use to have an entry and exit system. Then trust me, that professionalism you've always looked out for, you will become. So these three are key and are essential, and I'm going to be touching all these three in the 10 points that I have mentioned earlier. In these 10 points that I have mentioned earlier, I am going to be touching all these three put together. Okay, so now let's quickly go. Number one is form your market ideology. Some important questions you should answer genuinely before jumping to build your trading plan is: what do you think about the financial market? What do you think about the financial market? Okay. Now, sorry, I think I skipped something about the trading plan, right? So, trading plan basically is a plan that helps you to know the assets that you're trading, okay, your strategy that you're using to trade, okay, and then also your risk management rules and principles that you are abiding by, all right, and then also a set of rules to keep your psychology in place. All right. So let me go back and put that. So sorry. Let me go back and put that. So when we talk about a trading plan, a trading plan is a plan that helps you to identify and know your asset classifications, your the assets to be traded. All right. Of course, one of the things that is going to make you a good trader is for you to know that not all the 600 or over 400 assets you will trade, of course. So you should know, if you want to trade indices, you should know so much about the indices and select the certain indices that you want to trade. If you want to trade the currencies, you should know the currencies that you want to trade. If you want to trade commodities, know the commodities that you want to trade. So a trading plan is that plan is it is in that plan, all right? It's more like a journal. All right, so sometimes we call it trade journal. So in that journal, you're going to jot down, these are the assets that I am trading. All right, I have 10 assets that I have studied, I have understood, and they are the ones I am going to be trading. And then also your rules, your set of rules to guide your psychology. All right, set of rules to guide your psychology. All right, that is the next. All right, set of rules to guide your psychology. And then the next, of course, is your risk management system. Your risk management um system, right? And then the next we will be talking about is your technical strategy. Your technical what? Strategy. Of course. Sorry. Your technical what? Strategy. All right. So once you have been able to identify in your journal the assets you're going to trade, the strategy you're going to use to trade these assets, then your set of rules that guides your psychology, and then also your risk management, this forms what we call a trading plan or a trading what? Journal. Okay, so we can call that a trading journal. You should have all of these for the trades that you take. It will help you in most of the times to not make unnecessary mistakes. All right. Sometimes we don't master an asset, we just jump into want to trade. All right. Now, a trading plan is going to help you avoid certain unnecessary what mistakes. All right. So let's continue now. So we're talking about form your market ideology. Form your market ideology. Now, some important questions you should ask genuinely before jumping to build your trading plan is, what do you think about the financial market? What do you think about the financial market? Why do you think you can make money from the financial market? I can tell you a lot of times, some persons, the reason why they trade the financial market is probably they heard that a lot of people are making money from the market. Of course, that is true, but should that be the only reason should that be the only thing you know about the financial market? Should that be the only thing you know about the financial market? That the financial market, a lot of people make money there. And so you jump in, you don't want to complete your classes, and then you don't want to know what it entails, and then you just want to make money. Okay, you probably must have heard that somebody turned $100 to $100,000, and you'll be like, damn, and I'm older than this guy. Come on, I can do it. All right. You should know deep about the market that you want to trade. Now, things to also consider while building your trading are: one, avoid get rich quick claims. Avoid get rich quick claims. Now, let me tell you the financial market is not a get rich quick scheme. It is not where you put in $100 and especially in Nigeria, what is very common, you put in $100 and they promise you $1,000 in 48 hours. No, of course, the financial market is not a Ponzi scheme. It's not a get rich quick scheme. It's not a high yield investment program and all that. Okay, the financial market offers you these opportunities for you to trade the opportunities that you find part time. Okay, the opportunities that you find part time. And trust me, once you're able to select your assets to be traded, there are always opportunities that you can find in the market, and then you make the most out of such opportunities. Also think about who moves the market, demand and supply. All right, already have a video on already have a training on demand and supply. Okay, now for you to know who moves the market is very, very important. Know the big sharks. Let me take for instance, we have the NFP, the non-farm payroll. All right, now the non-farm payroll causes a large movement in the market. Now you cannot by yourself, or retail traders by themselves cannot cause such large movements in the market. But if you know what the NFP is all about, if you know what the NFP entails, if you know the actual, the forecast, the actual and the forecast of the NFP, then you would be in a good position to make the best out of that NFP that is to be expected. Now, the next is people are not perfectly rational. You need to understand this. All these we're talking about forming your ideology, your market ideology. People are not perfectly what? Rational. Now listen, if everyone were perfectly rational, the financial market will definitely fail. Imagine every one person trading the global financial market is thinking alike. So when they say buy, everybody sells. Of course, the financial market is going to crash. Now opportunities to buy and sell in the market exist because every trader has his own sentiment or rationale. All right. So somebody who is trading in the US could be buying an asset, while at the time you probably on your own time frame you're spotting a sell opportunity. So everybody is not rational, and that is why the forex market still exists till today. Now keep your trading plan as simple as possible. Keep it as simple as possible. No plenty details, no too much. Some people want to put in 100 candlesticks that they've seen in the market. A lot of people want, some people would want to put down in their trading plan 1,000 indicators and how they combine them. Just keep it simple, and that will do a whole lot for you. The next is choose the market that fits your trading strategy. Choose the market that fits your trading strategy. Okay, just a second. Okay, so choose the market that fits your trading strategy. Come on, not every asset fits your trading strategy. Personally, I have over 10 um 10 strategies that I use to look at the market. Now, I have noticed that some strategies I get a very good optimal use of some of the strategies on certain assets. So once I knew the optimal the once I knew that this strategy was yielded a optimal result for this asset, what I did was to stick that strategy to that asset. Okay, so not your strategy may not like most likely fit in all the assets. Choose the market that fits that your trading strategy. All right, there's so much to learn about each market, but you cannot start to learn in depth until you choose your trading plan. Now, if you choose currencies, you must understand what you're buying or what you're selling. It's very important. And then if you choose to trade equities, which is shares, you must also know what a share mean. All right, and also know about those shares company that you want to trade. Now, whatever you choose to trade, know what drives the market and its mechanism. It's very important. Know what drives the market and its mechanism, and that will greatly help. Okay, so the next is choose a trading time frame. Choose a trading time frame. Traders often ask these questions: when is the best time frame for trading? Should you trade the 5 minutes time frame or the daily charts? Now, for you to find the best price action trading time frame, start by answering these questions below. Number one, just four simple questions. Number one, how much can you risk? How much can you risk? How much do you want to risk? When you've been able to answer how much you can risk and how much you want to risk, the next question to answer is how much time can you spend on trading? I'm going to explain this very shortly, especially on risk management. All right, I'm going to do a whole lot of justice to risk management. So just follow me. Now, how much time can you spend on trading is the next question. Then the next is how fast can you analyze price action? How fast can you analyze price action? And then the last is what is the volatility and liquidity of your trading market? All right, you've chosen a set of assets that you want to be trading. All right, based on your knowledge on those assets, what is the liquidity like? All right, on those markets, on the assets, on those assets. All right, you need to know, you need to find out. All right, so let me quickly talk about the time that you can spend on trading. Now, let's give an instance that you want to spare just 2 hours every day to trade. All right, 2 hours every day you want to spend to trade. Now, those within those 2 hours, if you choose not to leave your trades for long term, it simply means that you want to be a scalper. All right. And we know already that scalpers are people who don't stay long on the market. All right. They find a trade setup, they find an opportunity, they rush into the market, stay for a little while, take some short profits, and then they leave the market. So their stay on the market is not long, right? It's very short, unlike the day traders, all right, or the intraday traders, or even the position traders. Okay, now once you say I don't want to stay long on the market, I want to pick short trades and leave the market, all right, it then simply means that the best time frame you should be looking for opportunities should be the 5 minutes time frame. Why? Because you don't want to stay long on the market, you just want to pick short trades and then you leave. But within the 2 hours, if you choose to find opportunities that probably could last for 1 day, for 2 days, or you want to find opportunities that could last you for opportunities that you know can be valid. Once you see this trend, you say, okay, I've been able to identify that this trend is going bullish, and then you want to know how long that trend is going to last. Probably it's going to last for the next 5 hours, it's going to last for the next 10 hours, or possibly even last for a day or more. Then you should be using the hourly time frame or the 4 hourly time frame. Now let me show you that. Okay, beautiful. So this is on a 4 hourly time frame. This is on a 4 hourly time frame. Supposing that I want to scalp, I don't want to stay long on the market. All right, the time frame I'm going to use is not our 4 hourly time frame. For instance, if I spot a buy opportunity here, this buy opportunity, if it is valid, is going to last for long. It's going to last for 2 days, it's going to last for 1 week or even more. All right, let me give you a quick example. Remember in the intermediate course, we talked about the moving crossovers, right? Beautiful. Now, look at when we had a sell signal here. The moving average 10 crossed over the crossed below the moving average 20, and the price action began to form below the two moving average. So, what time is this? We had the signal. All right. This is okay, one more time. All right. So this signal, we had this signal that was the 21st of December 2021. That was last year, 21st of December 2021. Now, when this signal came for sell, the market had been selling up until now. This is today is the 13th of January 2022. This is still selling. All right. Why? Because it's a 4 hourly time frame. All right. So this is on a long-term trades. Watch this now. We had this sales signal come around 12th of November 2021. You see that? But we if we're to trade this market and obey to the crossovers, we're going to probably close our trades here, right? This is when we had the next crossover. This is on the 25th of November 2021. That's about 2 weeks. That's about 2 weeks. All right. So you need to understand, if you can't wait 2 weeks for a trade, you can't wait 1 month for a trade, then the H4 time frame is definitely not for you. So within your 2 hours per day, if you want to if you want to take short trades, sorry, if you want to take short trades, then you go to the 5 minutes time frame. On the 5 minutes time frame, yeah, on the 5 minutes time frame, let's see, we have a sell signal here, right? And then it came up here. Um this was on the this was on the 5th. This was on the 5th of January. All right. You can see the same 5th the trade was closed. The same 5th the trade was closed. We had another signal. Did you see that? Now, watch this. From here you took your trade to where you're going to close your trade, that's about 15 points, 15 pips, I mean to say. 15 pips, you would have closed your trade and you are in profit. So the 5 minutes time frame is for those persons that do not have a lot of time to want to spend. But there is so much more to just time, like how much you want to risk as well, which I'm going to be talking about, and also how fast you can analyze your prices. Okay, the next is choose a technical tool to determine the trend. All right, just like in the intermediate courses, we talked about the moving average, the moving average crossovers, and also the trend analysis. All right, every trader with track record of success in trading had always tried to learn where the market is going. Every trader with track record of success in trading had always tried to learn where the market is going. Now, there are three main types of analysis for deciding where the price might be going. All right. The first is the fundamental analysis. The first is the fundamental. Three main types of analysis for deciding where prices might be going. The first is the fundamental analysis. Now, the fundamental analysis is analysis that is based on economical events, political events, and also government policies. All right. So you keep abreast to informations, you keep abreast to news and economic happenings around the world. Around the world, all right. And beautiful enough, on the equity platform, we have the news section, which you can use to keep up to date with informations. So once you have created an account and funded the account, all right, you're going to see the analysis portal, all right, pop up for you. But if you only create an account and get it verified, you wouldn't see the analysis portal, all right. So this analysis portal is for funded accounts only, all right. So you click on the analysis portal, you see the research terminal, the market calendar, the market news and technical newsletter, all right. It's beautiful. In the research terminal is where you get trade sentiments, all right, from around the globe, all right, for every instruments that you want to trade, from currencies, okay, from currencies, commodities, index, equities. You're going to find the sentiment. What are other traders around the world saying about a particular instrument, okay? So you can find that on the research terminal. And then also on the technical newsletter, all right, permit me, let me get to technical newsletter. On the technical newsletter, of course, you're going to be getting daily technical newsletter, daily signals. All right. Once this is only for funded accounts. The funded accounts enjoy this privilege of having this signal sent daily. All right, daily. And the technical newsletter have proven to have about 85% accuracy, about 85% accuracy. Yeah. So you can get trade setups, you can get trade analysis for commodities, currencies, like this is gold, this is silver, okay, this is for US oil. Beautiful. This is for still US oil futures, okay, futures of US oil. This is UK oil, It's amazing. It's amazing. This is for Euro USD currency pairs. So get your accounts funded and begin to enjoy this trade analysis sent by our market analysts daily, and it also gets delivered to your mail. All right, so we were talking about the fundamental analysis and how we can keep abreast to news. So on the equity platform, we also have the market news. All right, we also have the market news in partnership with the Dow Jones. We bring you news on um, on a daily basis so you can keep to date with happenings that affects the global financial market every time and every day. And then we also have the market calendar. All right, with the market calendar you can know major events and major happenings that affects certain countries, certain economies, and also certain markets. All right, for instance, here now we are expecting the producer price index that affects the US economy. So certainly by 1:30 Nigerian, by 2:30 rather Nigerian time, we're going to be having the price producer price index from the US. All right, and most importantly, what you're going to be seeing is you're going to be seeing the forecast, the previous, and also the actual. All right, now you should read about the producer price index. If the actual is greater than the previous, what does it do to the economy? Of course, it favors the economy. It simply means that US dollar is going to gain strength in the market. All right. If the actual is greater, so you should keep to date with informations as this so that it can help you to take proper decisions also in the market. So we have until 45 minutes before we have this news play out. And then you can see other news, US weekly export sales and all that. Okay, so all right, so that is for fundamental analysis. Keep abreast to news. Then the technical analysis we already have covered in the intermediate courses. It's an analysis that is based on information on the market due to the study of past data that we talked about in the intermediate course. Then sentiment analysis. Now, why applying sound technical and fundamental analysis is key. Having an additional feel for the market consensus can add depth to a trader's view on the market. All right, so you having an extra feel for the market, you after making the analysis based on your fundamental and your technical know-how, of course you having that your own personal feel, what you reason, what you think. All right, what's your rationale about the market? I haven't known the consensus agreement between the fundamental and also the technical. All right, it also gives a little hedge for you to make right decisions in the market. Now, however, taking trades on mere sentiments on the market can be disastrous. All right, so you cannot use the sentimental analysis, what you feel about the market, your guts about the market, you're biased about the market. All right, that is not enough to take a trade on the market. Okay, so the technical analysis is most preferable to determine the trend and can be more effective for trading purposes. All right. So most often we use the technical analysis, and that's why you're always going to be introduced to the technical analysis, even more of the technical analysis, even after the intermediate courses, the ones you find on the intermediate courses. All right. So the next we want to talk about is to define your entries. Define your entries. Define your entries. One of the feature of a good trading plan is having a good entry and exit system. Now, even with the right market context, you need an objective entry trigger. Both bar and candlestick chart patterns are useful triggers. Remember, in the intermediate course series, we talked about the candlestick chart patterns. Now, they are very important, all right, because they help you to know they help you to identify good entry points and good exit points to the market. Of course, when you find the shooting star in at the end of an uptrend, you should know that okay, the strength of the buyers are gradually nosediving. So if you're on a buy trade, you should start looking forward to closing your buy orders. Okay, so all of these builds your psychology and helps you have an objective view on your um entry and also exit systems. If you prefer indicators, oscillators like RSI and the stochastics are also very good options to consider. For instance, here we have in this chart the stochastics. All right. Now, whenever the stochastics move to the level of 20, we identify an underpriced asset, all right? And once the asset is underpriced, that is oversold. It simply means that the strength of the sellers are weak, and we will possibly have the buyers up in the market and begin to push prices what above, all right? Like here, you can see underpriced assets, and then buyers up in the market and begin to push prices what above. And then also, um okay, also at this point, right, it shows that the strength of the sellers were weak. Buyers will up in the market and push prices above. All right, so all these will help you find good entry and exit system. Now plan your exits as well. Plan your exit. A good exit is as important as a good entry you ever made. To what is your effort and analysis if you don't know when to take profit or when to stop loss from getting bigger? To what effort is your analysis? You need to plan how to exit when things go wrong. Okay, you need to plan how to exit. The market can go against you, causing you losses beyond your imaginations. Having a stop loss is very critical. All right, is very, very critical. Okay, you also need to plan how to exit when things go your way. So not only would you plan how to exit when things go wrong, but you also need to plan how to exit, like I earlier mentioned, when things go your way. The market will not go your way forever, never. Hence, you need to know when to take profits. You need to know when to do what, when to take profit. Now, let's go learn about stop loss. I've been talking about stop loss. All right. I've been talking about risk management. I've been talking about stop loss. Let's go learn about the stop loss. How can we identify good stop loss? All right. How to determine your stop loss. How to determine your stop loss. Now, let's first consider the wrong ways that people decide stop loss. Let's first consider the wrong ways that people decide what stop loss. Now, many times traders set up their protective level the very wrong way. The two questions below summarize the wrong thought process for setting a stop loss. The two questions below. So, these two questions tell how people determine their stop loss wrongly. Number one, how much do I want to lose? All right. Now, let's say I want to limit my risk to $200. Now, that is not a good way to want to determine your stop loss. Number two question is what is the implied stop loss price? Okay, so I am buying one lot of gold at 1,800. That is 100 ounces. Now, to limit my risk to 200, which I have earlier said, I must place my stop loss at 1798. 1798. That is where my stop loss will be for me to risk $200 only on this trade. That is if I enter the market at 1,800. Let me show you. So okay, so let's assume that this price level here is 1,800. This price level here is 1,800, and I entered the market to buy gold at this price level, all right, using one standard lot. All right, now to if you want to risk only $200, all right, it simply means that your stop loss simply means that your stop loss, all right, it simply means that your stop loss SL is going to be placed at 1798. Now, is this realistic enough? That is a question. A little retracement in the market, a little retracement in the market. Let me show you something. A little retracement in the market to um a little retracement in the market can just eat your stop loss and eat you out of the market. Whereas the buy trend is still valid. But because your stop loss was too close to your entry price, a retracement had eat your stop loss and then you lose the whole $200. And that is why this method to determine the stop loss is a very wrong method. All right, it is a very, very wrong method. Now, what is wrong with this thought process? What is wrong with this thought process is that it disregards market price action completely. Just like I said, you don't even put retracement to consideration while using this method. All right, it disregards market price action completely. Here we determine the stop loss level purely based on our risk preferences. Now, to the market, that stop loss point is arbitrary and meaningless. All right, because of course the market, you can't stop the market from experiencing retracements and pullbacks. Okay, and so you put yourself at the verge to always get your stop loss hit in the market if you use this method to determine your stop loss. Okay, so let's continue. The logical way to set stop loss. This is the right way now to set stop loss. So um buckle your seatbelts and let's get it the right way. A logical stop loss point is not implied by our risk appetite. No, that is why we always advise trade the opportunity, trade what you find in the market at the time. All right, and trade wisely. Okay, so a logical stop loss point is not implied by our risk appetite. It is highlighted by market price action. What you see in the market. What are the price action you see in the market? Now, stop loss levels based on price action allows us to limit our risk while giving breathing space for our trades to wiggle. Of course, trades are going to wiggle. Trades are going to wiggle. Let me show you something. Let me show you something. Look at this trade setup. Beautiful. Look at this trade setup. Okay. Okay. I'm coming. I'm coming. I want to show you something. Mm. Let's say we found this buy opportunity. We got this buy signal here, right? Sorry. Okay. Okay. Just a second. Beautiful. All right. So we got this buy setup here, right? We got this buy setup here. So let's assume we took a buy position at this price level, right? Now, we said we are going to put our stop loss. Now, we are not being realistic. We're going to put our stop loss at this level here. So this is entry price, this is stop loss. This is entry price E, and then this is what? Stop loss SL. Okay. Now, not being realistic, based on what we want to risk, our appetite, we put our stop loss very close to our entry price. This is what happened. It's not like the market is still not going. It's not like the buy opportunity we spot is not valid. It's still very much valid, but the market will wiggle. The market will have pullbacks. It will have retracement. Okay. Now watch what happened. Watch what happened here. We entered the market here. Of course, the market started buying. We are excited, and then it started moving sideways. And then look at the jump. It jumped. So our stop loss would have been hit even before the market started going our direction. And you can see all that. Now let's try to see, supposing we had our stop loss put the right way, find a swing point that is using support and resistance. We would have put our stop loss below this. Okay, so the market is the market is going to experience its pullbacks and retracements. So we put our stop loss levels based on the price actions that we see in the market. Now, there are two primary methods for finding stop loss points using price action. There are two primary methods for finding stop loss points using price action, and these we will quickly look at. Number one is the support and the resistance as stop loss. support and resistance as stop loss. That is very easy to find. Then the number two is volatility stop loss using the average through range, which is also very easy and we will talk about. So let's look at support and resistance as stop loss. All right, using stop using support and resistance as stop loss. Now once you decide your stop loss, you need calculate the number of pips from entry price. All right, okay, so let's quickly look at the chart here that is given on the screen, that what you can find on the screen. All right, so this is US oil. This is US oil considered as the West Texas Intermediate, that is WTI. Okay, that's why you can see WTI is considered the West Texas Intermediate. Now, let's assume that we find the pin bar here to take a buy position, right? We take a buy position here. So we long WTI setup. We found a long WTI setup here. That is long simply means buy, right? Now, stop loss should be below this support line. Of course, we have found this support line, and so we place our stop loss below this support line. So say somewhere around here. Now that's the right place to want to place our stop loss, and then we take our buy position here after discovering what the trade setup. Okay, now by this, we are safe if the market should experience any pullback. Okay, now also here, if we want to short WTI because of this pin bar that we find here, okay, we saw a sell opportunity using this pin bar here. Okay, our stop loss should be above our stop loss should be above this resistance level. Okay, it should be above this resistance level, so we can have our stop loss at probably this significant high. Considering this past level, we can have our stop loss using that past level. Okay, so this is one of the ways that we can determine how to place our stop loss using the support or the resistance. Okay, now once you're able to decide your stop loss, you need calculate the number of pips from your entry price, and then this is to know the number of pips you're willing to risk. Now next step will be setting your lot size in order to make your stop loss equal to the desired risk per trade in terms of dollars. Okay, so I'll still explain that now. I'll still explain that. Let's quickly look at this. Let's quickly look at this chart now. Okay, this is using the zigzag indicator. All right, so you can actually find the zigzag and probably use the zigzag if you want to go to insert indicators. The zigzag is a trend indicator, right? But sorry, it's a custom indicator, so we can find it in custom. So we use the zigzag. Once you impute the zigzag gives you something like this, so you can use the zigzag to know swing points in the market. For instance, here we have a swing point here, we have a swing point here. All right, let's assume that we found a good sell opportunity here with this swing point because there is a bearish engulfing pattern I can see here. So um, we take our trade after the engulfing. So this is our entry price, right? Now, how do we determine our stop loss? Our stop loss should be placed above this swing point, this swing points that act as a resistance zone. So we can place our stop loss here, all right, for a sell what setup. All right, okay. So stop loss should be below the support line, this support line, just like I have showed you on the live chart. And long positions, when price close above the moving average. Swing points are also natural supports and resistance suitable for placing stop losses, like I have also mentioned using the live chart. So these are swing points. This is a swing point. So once we can find an opportunity, right? Once we can find an opportunity, let's say for a sell trade here, of course, our stop loss should be at this swing point or a little higher than the swing point. By this, we probably decide by this we decide sorry so sorry by this we decide the right way on how to have our stop loss to our trade. All right, so let's look at the second method, which is the volatility stop loss using the average through range, ATR, using the average through range. So the average through range is actually an indicator that we also use to do many things. But one of it that I want to teach you today is on how to use it to determine our stop loss levels. So if you don't know how to install the average through range, okay, let's take this off. Okay. So if you don't know how to install the average true range, you come to insert, comes in indicators, and then you come down to oscillators. The average true range is an oscillator. All right. So we have the average true range. So just use the average true range with its default setting. Okay. Beautiful. So what the average true range helps us to one of the things that the average true range helps us to identify is how we can have our stop loss, okay, used on our charts. Okay, I'm coming. Okay, so we have the average true range already installed now. Now let's get down to business. The ideal stop loss is one that offers enough space for a trade to move freely, but we must also know how much space, that is a price range, that is enough. So the answer depends on the market volatility. Hence, another logical method for setting stop losses considers the volatility of market price action. Okay, the classic example of a volatility stop loss is the ATR, that is the average true range. The average true range can be used as a measure of market volatility. So the average true range helps us to identify the volatility of that asset we want to trade, and then by using a multiplier we can set our stop loss based on that average. Okay, by using a multiplier, that is a factor, we can then use it to calculate our what, our stop loss. Now the rule is this: stop loss for long positions, stop loss for buy positions, we determine the entry price. The entry price is going to subtract the ATR that we have currently at the time we started trading plus the spread, all multiplied by 1.5. Now 1.5 is the multiplier, 1.5 is the constant, okay, we call it constant or the factor, all right, used to multiply the ATR, and then we are good to go. All right, now for short positions we have the entry price plus, let me show you, don't forget this. For buy positions, let's say we want to buy here, so this is our entry price, EP, right? We want to determine the stop loss. Stop loss is usually below the entry price of buy setup, right? Now it's going to be the entry price minus the 1 ATR plus the spread, all multiplied by what, 1.5. All right, and for sell setup, all right, this is our entry price. We want to determine the stop loss. This is EP, right? All right, to determine the stop loss, we have the entry price plus the ATRO plus spread, all multiplied by the multiplier 1.5. So let's see how it works. Let's see how it works then. So looking at this chart now of gold on a hourly time frame, um, let's say what's the ATRO value we can find here? 2.6, right? If you look closely, you're going to see the ATRO value 2.6. So we can actually use the approximate value of what? 3, right? We can use the approximate value of what? 3. Okay. So for us to long, okay, sorry. So we identified a sell trade here, all right, a sell trade, and the entry price was at 1790. 1790. For us to identify where to impute our stop loss, we're going to use the formula that was given earlier, which is what the entry price for long positions. All right, for long positions, we're going to have the entry price minus 180 plus spread or multiplied by 5, 1.5. But for short positions, all right, it is the okay, let's just calculate it. So we have the ATR value, all right, which is 3. We have identified the ATR value as 3. Now plus the spread, all right. What is the spread? 0.3, all right. Okay, so we are having 3 plus 0.3, then all multiplied by 1.5, which is a factor. So can we have that on our calculator? So we have 3 plus 0.3, right? And that gives us 3.3. Now, all multiplied by the factor 1.5. That gives us what? 4.9. All right. So what do? We subtract this from the entry price in order to determine our stop loss. All right. So subtracting this from the entry price, what's the entry price? 1790. Okay. So 1790 minus this, all right? 1790 minus the 4.95 gives us what? 1785. And so um we are going to have our stop loss at 1785 should we want to take a long position here at this price, at this level. Okay, so this is a logical way, a better way that we can use to identify or determine our stop loss. All right, so define your risk next. Determine, define your risk. Once you have your entry and your exit rule sorted out, you can work on limiting risk. You can work on limiting risk. The primary way to do so is by position sizing. For a given trading setup, your position size determines how much money you are putting on the line. Double your position size, you double your risk. Okay? Now, position sizing has two aims. Number one is to first preserve our capital and also avoid huge losses. That is the first aim of position sizing. Now, huge losses are those that we will never recover from, all right, or it will take a longer time before we recover from. Now, this is a number one priority, and we must never risk ruining our trading account. So number one priority in trading is never risk so much to lose your entire account. All right. Number two aim for position sizing. However, if the sole purpose to preserve our capital, if the sole purpose is to preserve our capital, then the best solution is to not trade at all. Trust me. So there would be risk, of course, but if we're scared of incurring the little risk, all right, it simply means we shouldn't trade to start with. Now, hence, position sizing has a second aim, which is to maximize our profits. The second aim of position sizing is to what? Maximize our profits. So let's quickly continue. If we trade a size that is too big, we risk going broke. If we trade a size that is too small, we limit our potential profits. Just like I have earlier mentioned, thus, we want to find the best combination that maximizes our profit while protecting our trading capital. Let's take a look at two position sizing models that try to maximize profits while preventing risk of losing your trade. We're going to consider first how to use a position sizes. We're going to consider two of them. First is the fixed percentage position, and then the next is a maximum drawdown positions. They are quite easy, so let's just delve into them. Let's start with the fixed percentage position. Now, most times it is advised to limit your risk to not more than 2% of your trading capital per trade. Most times it is advised to limit your risk to not more than 2% of your trading capital per trade. Now, let's assume that you have a $10,000 trading capital and you are risking only 2%. 2% of $10,000 is going to give us what? $200, right? 2%, 2% is 0.02, right? Multiplied by $10,000, that gives us what? $200. So it simply means that we want to risk $200 per trade. Now, using the fixed percentage position, we are going to have the fixed percentage, which is 2%, multiplied by the trading capital. Okay, sorry, which we've already determined our risk exposure per trade as $200. Now, for you to calculate the position size and according to the amount that you want to risk, then you are going to have the risk per trade divided by your entry minus your stop loss, all multiplied by your peak value standard. Now, don't get scared with all of this. It's very simple. So let me give you a perfect example to explain this formula. For example, you go long on Euro USD. All right, you go long on Euro USD at 1.18697. So this is your entry price for Euro USD, and then you are putting your stop loss at 1.17768. Perhaps that is stop loss determined based on the ATRO, or the stop loss determined based on support and resistance. Now, beautiful. If we want to calculate our position size, what is a lot size? When I mean position size, what is a lot size we should trade with, such that if the market go against us and gets to our stop loss, we will not risk more than the $200. What do we do? We've known that we want to risk the $200. That is per trade. We get our $200 divided by our entry minus our stop loss. All right. We have the entry. We've determined the stop loss as well. I have already talked about how to determine your stop loss. All right. So your entry minus your stop loss. All right. Let's quickly do that. Your entry minus your stop loss. That is 1.18697. Right. Okay, minus 1.17768. That gives us 0.00929. All right. So this minus this gives us this 0.00929, all multiplied by the peak value standard unit. All right. This I told you when I taught you lots and contract sizes, that a standard contract size is what is in a measure, or is in a multiple of 100,000 what units. So multiplied by the 100,000 units, we have 200, all divided by this. So the position size you will get is 0.22. What this simply means that if you take the trade, the lot size, if you take this Euro USD, if you buy Euro USD with 0.22 lot size, and then the market goes wrong and the market goes wrong and eats your stop loss at 1.17768, you're not risking more than $200 for this trade. All right. Now, if this process is too difficult for you, you can alternatively go to Google Play Store, download the Forex calculator, and also use it to find your position size. But first, determine, okay, the Forex calculator is going to also ask you to put in your risk percentage. Now, this is fixed percentage position. This is fixed percentage positioning. The next is maximum drawdown position sizing. Now, in order to decide the position size, these steps must be followed. Now, let's follow the four simple steps, and then trust me, it's simple, right? It's super easy. Number one is to decide the maximum drawdown you're willing to take from your entire trading capital. Determine the maximum drawdown you're willing to take from your entire trading balance. Now, take for instance that your trading capital is $100,000. Now, set a percentage for the maximum drawdown. Some persons would not want to risk more than 30% of their entire trading capital. Some persons would say they don't want to risk more than 40% of their entire trading capital. Once you're able to determine how many percentage of your entire trading capital you want to expose to risk. Now that is the first step. So let's assume here we decided 30%. So hence 30% of $100,000 is what? $30,000. Now that is our maximum drawdown. Maximum drawdown. The number two thing you're going to do is now, it is, remember, the drawdown is your entire capital. You've determined that the maximum you want to expose to risk in your accounts. Your entire trading capital is what? 30%, which is $30,000. The next step is to determine how many trades you want to make from your whole trading process in the period of time. For instance, 100 trades per 2 weeks wouldn't be bad. It's preferable to choose between 50 and 100 as number of tries, or the number of trades, because of the higher what number of 30% of your trading capital. Now let's say we are working with 100. All right, so we want to take 100 trades, all right, in trying a 30% maximum drawdown exposure of our total trading capital. Now the number three step to do is to determine the risk, to decide the risk per trade by dividing the maximum drawdown by the number of trades. So take for instance, we've decided a 100 trade, $30,000 maximum drawdown. So it's going to be $30,000 divided by $100. That gives us $300. It simply means we have $300 of our account size to risk per trade should we want to take 100 trades. And of course, this is why you should also know the win ratio of your strategy that you're using. All right, know the win ratio of your strategy. If you're using a strategy that uses um that has 60% win ratio, of course you're safe. All right. It simply means that 60 trades out of the 100 trades you're going to take, you're going to be in profit. I'll show you that very shortly, how you can break even with your strategy. All right. If you know how many percent, how many the success rate of your strategy, all right, if you know the success rate, the percentage of your success rate of your strategy, then you will be able to better appreciate and know when you can break even using that what strategy. All right. So the number four thing to do is, once you have been able to decide your risk per trade, you can go back and apply the previous formula to find the position size. All right. You can go back and use the previous formula to find the position size. What's the previous formula? The whole process that we went through using the um, fixed percentage method, or you alternatively can use the forex calculator as well. All right. This makes sense, right? So deciding your take profit. Remember, deciding your take profit as well is very important. Always make sure that your take profit level is more than your stop loss level. Always make sure your take profit level is more than your stop loss level. The rule for taking profit is that your take profit should be greater than or equal to your stop loss multiplied by 1.5. What this simply means is this: if you want to risk what this simply means is that if your stop loss is say 20 pips, if your stop loss is 20 pips, all right, your take profit should be greater than or perhaps equal to 20 pips um multiplied by 1.5, and that gives us what? That gives us 30. So at least you're risking 20 pips to get what? 30 pips. Now, this is a simple and standard way of deciding your take profit level. But there are some other methods on deciding your take profit level. So I will show you that very shortly. So by using 1:1 risk reward ratio, you will make profit if you win 60% of your trades. All right. So the question now boils down to your technical strategy. Do you have a technical strategy that gives you over 60% success rate? It simply means over 6%, over 6 times, or 60% of times you take a trade, you win. All right. You need to consider that. Now, if you use if you use 1:2 risk reward ratio, that is, you're risking one to get two. All right. I just explained that here. It simply means if you're risking 20 pips, you're looking at getting 40 pips. If you use 1:2 risk reward ratio, you will make profit if you have 40% of your trades won. Okay. If you're using 1:3 risk reward ratio, you're risking 10 pips, but you want to get 30 pips, all right, in your trade. Now, you will make um you will make profit if you win 30% of your trade. So it all depends and boils down to your technical strategy, all right, and how much and how well you understand the market. Now, look at this diagram here. We have on the vertical column the risk, and then on the horizontal column we have the win rate. All right. So if you're using 1:1 risk to reward ratio, okay, you're only going to break even if you win 50% of your trades. So you can only start making profits if you win 60% of your trade and above. If you're using 1:2 risk to reward ratio, you're only going to start making profits if you win 40% of your trades and above. If you're using 1:3, you're only going to start making profit from 30% of your trades that are won. Okay, if you're using 1:4 from your first trade, all right, if it is one, 20%, at least from your 20% of your win trades will make you break even. And then if you're using 1:5 risk to reward ratio, you're going to break even from at least 10%, and you start making profit, okay, from 10%. Yeah, 10%, of course, 10%. So you break even and you start making profit. So several other techniques for are there for grabbing profits. All right. Apart Aside the risk to reward ratio system, there are several other techniques that one can use to grab profits. The first is a chart pattern target projection. Remember, I told you about trend line. All right. That a bullish trend is identified by higher highs and higher lows. Sorry, a bullish trend is identified by higher highs and what, higher lows. And so um if you take a trade, let's say here, this is your entry price. Because of your knowledge of market structure, that you know that okay, market is going higher highs and higher lows, and you know this is a bullish sentiment, you're sure going to know that the next high that is going to be created is going to be higher than this previous what high. So what should you do? Using the chart pattern target projection, you can have your take profits at this price level or at a higher price level. So this could be your take profit level, or this could be your take profit level. Why? Because you understand market structure. And if it's a selling trade, the same thing applies. If you take a trade here, sorry, let me clean that. All right. So if it's a selling trade, let's say we take a sell trade here. Okay. Okay, let's say we take a trade here. So this is not formed yet. Because of our understanding of the market structure based on the definition of bearish trend, lower highs and lower lows. So we know that the next low that is going to be formed will be lower than what? The previous low. And so what do? We can take a trade here. I have to draw this well. I have to be better. Okay. All right, so if we take a trade here, we can look out to closing out that trade at this level, because we know it will create another low, all right, lower than this previous low. All right, so um um this is how we can use our understanding of market structure to target our profits, our take profit price levels. We also can use the Fibonacci extension or past swing points, and also price channels. All these are methods we can use to decide our take profit level. Okay, so the next on our journal is write down your trading rules. We're almost done. Write down your trading rules. At this stage, your trading strategy is simple. You probably must have used it again and again. You must have mastered it. It's now simple because you have put in everything into consideration, your risk reward, your risk management rules, your entry exit strategy, your you've put everything together so you understand what you are doing in the market. You are not gambling. Okay, you might be able to memorize the trading rules. However, you must still write down your trading rules. That makes it a journal, right? Having a written trading plan is a robust method to ensure discipline and consistency. It also provides a record of your trading strategy. You will find it useful when you're trying to refine it. Okay, so write down your trading rules. Write it down. The assets you're trading, what you found, what did you see that made you decide to enter the market for buy? How did you determine your stop loss? Okay, was it the best way to determine that stop loss? You should write it down. It will help you a lot. All right. Then the next is backtest your trading strategy. All right, backtest your trading with your written rules. You can now backtest the strategy. Whenever I use the strategy, how many times did I get a win ratio? How many times did I get it on my stop loss? All right, you would be able to know all that. If you have a dis discretionary trading strategy, backtesting can be an arduous process. You need to replay the market price action and record your trades manually, right? So that's for manual backtesting. For manual backtesting, if you have a mechanical trading strategy and a coding background, you can speed up this process. All right. Now, nonetheless, looking through the trades one by one is a great way to develop your market instincts. Doing so can also help you think of ways to improve your trading strategy. All right. So backtest it. Know how many times it gave you win. Know how many times you got it on your stop loss. Plan to improve your strategy, and this is going to be the last. Plan to improve your strategy. Check for new indicators or new setups for entry and exit points. Use the demo account for new technical strategies. You found a new strategy, you don't jump to your live account and start using it. You go to your demo account, you practice the new strategy that you've been able to find or develop, and then once you're sure of the once you're sure of the success rate of that strategy based on your back test, you can come back and then use it on your live account. Now record your trades, especially the losing one, and figure out why the market went against you in the first place. That is going to help you to make better decisions in your next trade. The last, then check your fundamental knowledge. Check your fundamental knowledge also. So thank you so much. We've come to the end of the advanced course series. Um, do also ask me your questions. I'll be glad to entertain all of your questions and answer them. All right. Thank you so much, and see you in the mentorship classes. Don't miss the mentorship classes. And we talk more about the market and how to make the most out of the market. Thank you.